Vanguard, First Trust, Goldman Sachs, Morgan Stanley. Lots of really, really, really smart people. And to me, they're proving to us one thing: nobody knows.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome into Your Life, Your Money. I'm Ben George. He's Scott Searens, President and Financial Advisor at Searens Financial Group. And we're kicking off the new year, Scott, with a little talk about the stock market. And we're going to go through some projections and some predictions. I mean, I think it's kind of interesting to see what people think because it's kind of all over the board.
You're right. When we go through it today, I think people will be astonished that there's, as you had mentioned, it's all over the board. There's nobody that's predicting the same as the next person. And so what do we, how do we take this? What do we do about it? And what do we do with our plans in regards to it? So I look forward to it.
Yeah, it should be a fun conversation. So we'll go through that today. How's everything else going as you kick off the new year?
Things are great. Thanks for asking. It's with the New Year's, right? Lots of sports games out there. I don't know about you, Ben, but when you're watching sports games or on those sports days, do you see any of those ads on your phone to place your bets or get started in any of those sports betting programs?
It reminds me of it's probably been almost like 8 or 9 years now when DraftKings and FanDuel first launched, when they were just doing the fantasy stuff. And I mean, it was ads. It seemed like if you watch one game, you'd see 10 ads for that same company. And now it's just shifted gears from fantasy to sports betting.
You're right. And heck, now because, different states where it's legal, I mean, it's actually not just on your phones, but it's the commercials on TV. I mean, it's everywhere. Now, do you do any sports betting yourself?
Yeah, I do a little bit. I enjoy it, especially when we don't have it where I live currently, but hopefully soon. But yeah, I do enjoy whenever I get to a casino or go to Vegas or do a trip and it's there, I'll put a couple of bets down.
Gotcha. And it's one thing that I just haven't gotten into. I mean, I probably, like you've mentioned, been in Vegas, and I've maybe thrown a bet down just because I was in Vegas. It was, the thing to do. But I don't know. I don't trust my gut to predict who's going to win.
Yeah. I mean, you can take all the factors, but, at the end of the day, you cannot predict the future, right? Which is kind of fitting for what we're talking about today. Yeah.
And, you look at different potential bets too, right? Like, let's just say tennis, right? If you have a singles match, so you've got two people, you're really reducing those factors, but then you start to look at other bets, right? Like on football, and now you've got you've got your offense, you've got defense, you've got all these guys that could potentially get injured, and then you're looking at the location, and is it going to snow? Is it going to rain? Is it going to be really hot? Is the other team used to it? And I know some people love to get into all of that, and I look at it and go, there's no way I'm going to be able to predict who's going to win this game.
And then if you do college, then you're talking about, these kids are going to school, what's going on in their personal life. Like, there's just so many factors that go into it. It's interesting, but it's very popular. It is a moneymaker for many, many states. So
you were correct. Very popular.
Very interesting. All right, well, let's talk about stocks then, because we're talking about kind of predicting things and how is there a way to try to predict an outcome, right? That's what we're trying to do with sports betting in many cases. And the stock market is very similar. I mean, a lot of times we are taking on quite a bit of risk, depending on how you build your financial plan. You might be taking on less than others or more, depending on what kind of returns you're trying to get, what you're comfortable with. But there are some companies out there, some of the major companies that assess and evaluate this stuff year to year, have kind of put out some projections on kind of what they think's coming up. And we've been in this kind of weird space with COVID, right? But I think it's a good idea to kind of run through some of these, Scott. I'm going to maybe just throw out the company to you and let you kind of tell us what they said and then maybe some thoughts on that.
Yeah, I think that's great. And I think it's good to remind people too, these are just predictions, and I really want them to stick around because, at the end of talking through what each of these companies have talked about, that's when I'd really like to wrap up. Hey, what does all of this actually mean to a person, to their portfolio, to their overall plan? And I think it'll be a really good conversation.
Well, let's start off with Vanguard. This is one of the leaders, right, in this space. And
big company.
Everybody knows Vanguard. You probably have a couple accounts through them, more than likely. Looking at theirs to kind of lead off, they're not as optimistic on things as maybe some other people.
Yeah, so, I would say in comparison to the different companies that we'll be sharing with people today, they're kind of maybe middle of the road, probably lower side of the optimism side of things, but they are on the optimistic side. And Vanguard was projecting. Now, their projections here were what they called 10-year annualized returns. So they weren't just saying, hey, here's what we think is going to happen in 2022. They're saying, here's what we think is going to happen, if you took the next 10 years and then averaged it out. And for the U.S. equities, U.S. stocks, they're saying a 10-year annualized return of 2.3% to 4.3% per year. So they're not given a specific number here, just kind of a range. The non-U.S. developed markets, 5.3% to 7.3% per year. And then the emerging markets, 4.2% to 6.2% per year. So, I think a lot of times we just hear different things that are out there. Or if somebody says, hey, what's the, stock market, returned from inception, or from, what has history shown us? And a lot of times that 10% number comes up. So just look at what Vanguard's telling us here. They're kind of making a forward-looking 10-year prediction of averages somewhere maybe from 2 to 6%.
Yeah, it's interesting to hear what they have to say. Then you got First Trust, our next one here on the list that we're going through. A company that's been bullish over the past year or so, even throughout COVID. I'm curious what they had to say about what's ahead.
All right, so now they're a company, right? They're putting their name on the line, right? They're saying, hey, we'll give you a 2022 prediction. And their 2022 prediction, they're saying that the S&P 500 is going to hit 5,250. And just to give you an idea, I looked at where the market is at today as of this recording, right? So we're kind of mid-December here. 5,250, the S&P right now is around 4,600. And of course, that's going to fluctuate. Market goes up and down. So they're bullish. They're still bullish. And then they said the Dow, right? They're predicting the Dow by the end of 2022 to hit 40,000. And right now, again, the market's right around that 35,000 range, or the Dow is. And so, hey, they're, in comparison to Vanguard, I'd say they're a little bit more bullish on their 2022 predictions.
Yeah, because, you look at where the market is now, it's about recording about 35,000. So, you're talking about a pretty nice gain over 2022. So that'd be interesting there. Goldman Sachs, we always hear from Goldman Sachs a lot, another top company in this industry. What do they have to say?
All right, so Goldman Sachs is saying that the S&P 500 is going to climb by 9%. Now, this was 9% from when they put out their prediction, but in the end, they said, hey, we feel that the S&P is going to get to 5,100. So let's see. We've got First Trust saying 5,250. We've got Goldman Sachs saying 5,100 by the end of the year. So again, another bullish company here. They're saying, hey, things went well in 2021, and they feel that things are going to continue to go well in 2022. Now, they put some, which I think everybody does, right? We'll link in the show notes to everyone's predictions here, because I think if you read through it, right, they always put a lot of caveats. Hey, this needs to happen, that needs to happen, if these economic conditions happen. Because they said something else too. They said decelerating economic growth, a tightening Fed, and rising yields suggest investors should expect modestly below average returns next year. So that was kind of interesting, right? They threw out this, hey, we feel that things are going to be great, kind of more of a bullish return, but then they also kind of threw in their caveats on their predictions there of what might get below average returns as well. But they're still thinking, hey, things are going to be positive.
Overall positive from Goldman Sachs. Okay.
Yeah.
What about Morgan Stanley?
Now, Morgan Stanley was actually on the other end of the spectrum here. Okay. So Morgan Stanley said, hey, we think that the S&P is going to close lower. So as we're talking, S&P right now around 4,600, and Morgan Stanley was saying, hey, we think that by the end of 2022, the S&P is going to close maybe around 4,400. So now we've got one big company saying, hey, we think that there's actually going to be a decline next year in the stock market.
Well, you look at all this, and it's like, who can predict it? Because we look back. Obviously, just 2 years ago, a little less than 2 years ago, we had COVID hit, and then, you don't have to go back much further than that to remember 2008, right? I mean, these things are all still fresh on our mind. There was a number of crashes that maybe in retrospect you say, okay, maybe we could have seen this coming, but honestly, who could have predicted these things?
That's a great point, Ben. I think we're talking about all of these predictions, and you can read until you can't read anymore, and there'll be another prediction out there to read and another one out there to read. But then you got to look at both sides of the picture too, because as you had mentioned, we've also had stock market crashes that nobody could have predicted. I mean, 2008, the financial crisis of, when basically we were loaning out way too much, or banks, mortgage companies were loaning out way more than they should have been in regards to loans and funds for people for mortgages. That was one that would anybody have predicted that would have happened?
No.
Not a few, maybe one or two people hit it right, but it was probably just a guessing game for them, because if they were going to predict it, then we could have saved a lot of headaches in 2008. Same thing in, early 2000s with the dot-com crash. I mean, everybody just got so euphoric about, all of these dot-com stocks, but nobody could have predicted that was going to crash either. So, there's so many bear predictions, just as well out there as all of the bull predictions. And I think that's what makes this tough. And that's why I really wanted to have this discussion this morning, right? Like, we've got 4 big companies: Vanguard, First Trust, Goldman Sachs, Morgan Stanley. Lots of really, really, really smart people. And to me, they're proving to us one thing: nobody knows, right?
Yeah.
Big companies, a lot of really smart people. Nobody knows what the stock market's going to do in the future. And so the point here is, even though we're talking about it and providing what these predictions are, I'd really recommend not to look at the predictions. That was the point that I really wanted to get across, is that all of these were different and nobody knows. So let's not look at the predictions. Let's not try to predict what the market is going to do, because we really can't worry about what we can't control. Just like we're talking about the sports betting and like the college football games and all of the different potential ways that could come about to change those games. I mean, the same thing happens in the stock market. There could be economic changes. There could be stimulus changes. There could be tax changes. I mean, there could be, weather changes, right? Just like a football game, we could have weather changes where it's fires in California or hurricanes that, wipe out plants and facilities and towns, causing different stocks to rise and fall more than anybody would have, predicted before.
So what do we do with this information, Scott? How do we prepare, knowing that, even if our best guess is close, that there's going to be factors, anything could pop up and completely change the outlook of the year and the next couple of years. So what does this mean from a planning perspective?
Well, I think you named it right there. It means that we need to have a plan. And if you're building an investment portfolio, knowing that even the largest companies out there can't predict what's going to happen in the stock market in the future, you need to have a focus on the long term, rather than just trying to look at 2022 and is it going to be up or down and how much is it going to be up or down. Is focusing on that long term. One thing that that we have seen, and of course with everything that we discussed today, right? Past performance isn't going to be indicative of any sort of future results. But one thing that we have seen over history is that focusing on equities and stocks has provided more return than focusing on bonds, which is loaning companies or the government money. And so, looking at your time horizon, knowing that there's risk with stocks, maybe a little bit less risk with bonds, use your time horizon, focus on that long term to determine, okay, hey, how should you construct your portfolio? But again, focus on not just investing for 2022, but saying, hey, this money is going to be put aside for a really long time. Now, looking at your time horizon, if you need money, income, cash, if you need income over the next 5 years from your portfolio, well, then it's maybe a good idea to put that on the safer side, on the bond side. I always like to nickname that the war chest. of your portfolio. So you need something over the next 5 years, put it on the safer side of your portfolio. You need it within the next year, move it to cash, right? Because what goes up, as we mentioned here, could also go down. Nobody would have predicted some of those different crashes. And then, hey, anything that's, maybe longer than 5 years out, you might not need that money for 5 years or longer. Well, then that's where we can, potentially take those chances, put it more on the growth side or equity side of our portfolio, knowing that, hey, if some of these unpredictable events like the crash of 2008 or the, crash that we saw during COVID, if any of those events come up, hey, we have the time to weather that storm and to, let our funds grow back up over that future period of time.
Yeah, I think the biggest message, as you said, is, you're not going to be able to predict it, but, you want to have a plan that can kind of account for different scenarios and, give you peace of mind. That's what you don't want to be worried about your finances, right, Scott? Even in the worst of times, you're going to worry some. I mean, it's impossible not to, but you're going to be outperforming what everyone else is doing in the market when things are dropping 40, 50%, right?
You're right. Like you said, yep, it's just human nature to worry some, especially if you do see, one of these crashes or bear markets come. But we should try not to worry about what we can't control until we take what we can control and utilize that, meaning just like we talked about, need it within a year, probably should be sitting in cash. If you need it within 3 to 5 years, well, then maybe it should be sitting on the safer side of our portfolio. And if it's 5 years or longer, hey, we've got that ability to take that risk and put that at not only more growth, but more growth, which could also be a little bit more risk.
Well, if you want to sit down with Scott and talk about your portfolio and your investment strategy, and if you don't have one, a plan, let's go ahead and put that in place for 2022 as well. You can find Scott online, lifemoneyshow.com. That is the hub for all the content that Scott puts out, both podcast and video as well. But you can call him directly at 847-235-6989 to talk about that as well. Got a question today for you, Scott, before we close out this episode of Your Life, Your Money. Came in from Victoria, who said, my husband wants to leave a lot of money to the kids, but I've worked hard to be able to retire, and I don't want to scrimp and save the rest of my life. What do you see as a reasonable amount to leave as a legacy?
Well, I tell you what, Ben, this is a pretty subjective question, right? Because she says a lot, and a lot can mean a different amount to a different group of people. Does this mean 10,000? Does this mean 100,000? Does this mean 500,000? Does this mean $1 million? I've had working with a lot of different clients. I mean, I've had clients who said, yeah, we want to leave a legacy to our children. And for each of those clients, a lot means a different amount. So what I would recommend for Victoria, because I think the other part here, I was kind of reading into this, Ben, but she's like, wait a second, I also want to live my own life, right? She's like, I don't want to scrimp and save for the rest of my life. So I'll compare it to this, I think about it this way, Victoria. If you were to be making dinner for you and your spouse, and you're just to be making dinner for tonight, right? And let's say I'm a steak and potato guy. So let's say we're just going to have a steak and potato dinner. Well, you know that you're going to go out, you're going to buy 2 steaks. You're going to buy how many potatoes that you need and, any other sides that you need just for that dinner for tonight. But if you say, hey, you know what, my spouse and I, we would really like to have leftovers for 3 days or 4 days. Well, now we're probably going to go out and buy 4 or 5 steaks, a lot more potatoes, a lot more, other sides in regards to that, because you want those leftovers for that specific amount of time. You know the ingredients for the base, right? That one dinner just tonight, but you also know how much to increase that if you're wanting leftovers for the next 3 days. And so the reason I bring this analogy up is, first, I think what's important for Victoria and her spouse is, what do they need to maintain their lifestyle today? What's their base dinner? And what are the ingredients for that dinner? How much do they need to save up to make that happen? And then determine how many days of leftovers do they want, meaning how much of a legacy do they want to pass on to their children. Sounds like they might have a little bit, of difference of opinions here. So I'd say it's just something that her and her spouse needs to sit down, determine, and kind of come up with an idea of, okay, hey, let's target this amount. And then once they know that target, now they know how much they might need to increase those ingredients, meaning how much they need to save to make it all happen. And when it comes to legacy, maybe it's saving more money, but there's also other instruments and tools that you may want to consider, like utilizing life insurance to create that legacy. But I think first is understanding what's your base, and then what are you trying to target, and then you can work backwards from there to determine how much you need to save or what it is you need to do to hit those targets. I think a lot of times we just kind of throw these, random thoughts and ideas out there. We say, oh, we want to leave them a lot of money. But once you start to narrow it down into actual specific numbers, it helps you narrow down how much you need to save, how many ingredients that you need, and then you don't have to feel like, oh, I've got to scrimp and save for the rest of my life.
Mm-hmm. Yes, it's just a reminder that legacy and estate planning is so important, right? It's one of the pieces of a comprehensive plan.
One of the many pieces, putting it all together.
Yep, absolutely. Well, that's what Scott and his team at Searns Financial Group will do for you. So if you do want to talk through it a little bit more, same to you, Victoria, if you want to talk through this a little bit deeper and actually go through a plan and see what you can put in place so that everybody's happy. I mean, that's the name of the game. You want everybody to be able to enjoy their money, their retirement the way they see fit. So we appreciate that question as well. If you have one for us, send it in to us. You can do so at lifemoneyshow.com, or you can call Scott directly, 847-235-6989. All right, Scott, we will close it out on that note. Good start to the new year. If you do decide you want to place a few bets this year, let's just make it out of that fun money, right? The money you don't mind losing.
That's a great point. Yeah, use that fun money.
Exactly. All right, Scott, appreciate it. Look forward to next episode coming up. We got a new one every single week, so make sure you subscribe to the show wherever you listen, and we'll talk to you next time.
Thanks for the great conversation.
Searns Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Searns Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Searns Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Searns Financial Group, Inc.